Welcome to this video, Why Invest in the Stock Market? Invest with James. Roll the intro, let's get started. If you have a target to save, buy button, time for a cup of tea. So the big question everyone asks, why invest in the stock market? Well, on the long term, it's one of the best performing investment avenues. Other options are available, of course, investing in real estate, for example, but that requires a lot of cash down in order to get started. But the stock market is much more affordable and everyone can get started. One of the objectives of investing in the stock market is to outpace inflation. Everyone's affected by inflation. Therefore, making investment and wise investment choices helps outpace inflation. As you're aware, inflation is when prices increase over time, which is great in some ways, but it eats into your capital and you have less spending power every year as prices go up. Investments do better than inflation, you end up with still more money in your pocket. Let's just go through a very easy example of that. So let's say you invested some money. Your return on that money is 5% a year, and inflation in that year is 2%. Therefore, the true return of that investment is only 3%. Of course, if you take off a platform fee or a brokerage fee, maybe around 1%. So the actual true return to you is only 2%. Therefore, investing wisely and investing well over the long term, you can be sure to be outpacing inflation and make your investments work very well for you. And a disclaimer, I'm not a financial advisor. You do need to seek independent financial advice. This channel is for educational purposes only. One of the key things with investing in the stock market is to invest over the long term and not just the short term. One of these key parts is to avoid the impulsive buy and sell. That's when you're trying to sell or buy. That's when you're trying to time the market. Normally the emotions run high when the market is in decline, but that's actually a good time to buy and not to sell. Therefore, keeping your emotions under control and looking for the long term is so important. Let's have a look at this chart here. How to invest in the stock market. You can see if you're short term, you will see volatility. Therefore, it's best not to watch everything day by day. You're looking at the long term, months, years, decades even ahead. You see, how would you react in the short term if the market fell by maybe 15, 20%? It's avoiding those emotional impulse sell-offs during those times of downturn that help aid the benefit of long-term investing. As you see, normally long-term investing always has an upward trend. This is why I follow many large investors. Warren Buffett is probably my favorite. He calls investing boring. And part of that is because you have to have a long-term view. Nobody gets excited that your share that you just bought hasn't gone to the moon this year. But if you compound your efforts year after year, or in his case, over 70 years of investing, he knows how to play this game. One of my favorite quotes of his is, "The market is a device from transferring money from the impatient to the impatient." By that, he means the impatient people are the people that sell in a short downturn panic. And that money then is transferred to the long-term investors such as himself. So when the market goes down, he starts to buy, or even when it's declining, he knows people are selling and he's going to be buying. So over the long term, he just snaps up and takes a long-term view that his investment will rise. We're going to look here just at how £1,000 invested would grow over the last 30 years. Take a look at this chart. There have been many periods of decline. For example, the 2000 dot-com crash, where the market collapsed maybe 15 to 20%. This is all based on the FTSE 100, by the way. The most recent episode that we've all experienced only a few years ago, the COVID-19, started in 2020. The market declined some 15 to 20% on the FTSE here. But you will see over 30 years, you have taken a £1,000 account up to nearly 8,000. So that's an 8-fold return in just 30 years. That's a very good average when you analyze that return. So when investing in the stock market, there are two key categories to look at. You have stocks on one side and bonds on the other. Bonds, we'll start with bonds. Bonds is a loan, therefore you're a creditor to that company. Bonds are much more stable in the short term, but with that stability, you get a much lower return. Normally, they will give you a guaranteed amount of interest, which is more comforting. Therefore, it's always wise to hold bonds as you near retirement. Stocks, on the other hand, are ownership of the business. Therefore, they're shares of the business. They're much more volatile over the short term, but they always perform much, much better in the long term. Therefore, there's always this balance between risk and reward. If you want a higher risk, you will more likely get a higher return. It's not always the case, so you need to weigh this up for yourself. I do a video just here on evaluating your risk tolerance. That's very important for what tolerance you are comfortable with, and that is key to your investment decisions. And to show you a real example of long-term growth, I'm showing you a chart here of one of the long-term ETFs that I hold. This is with the SDPR, the World ETF. That basically buys shares in all of the main world companies. That's some 1,600 different companies. You'll see on this chart, relevant on today's recording, the growth over the last 5 years is some 75%. If you analyze that, if you annualize that, that's 15% return per year. Of course, looking at average helps you to give a guide of past performance and what similar experience you'll expect going forward. The reason I choose this fund is it had a nice steady growth. Yes, there are some areas of downturn where you can see the red in the early part of 2020. Of course, that was a COVID, where most markets were not immune to this downturn. But even since then, they've all recovered very steadily. And to reference another of my key investors that I like to take wisdom from, that's John Bogle and his book, The Little Book of Common Sense Investing. I absolutely love his expression. Don't look for the needle in the haystack, buy the whole haystack. That's the whole advantage of buying ETFs. That is in my later video explaining why ETFs are so important and one of the best investment avenues, one of the best investment strategies that you should take to get started investing in the stock market. And there we go. That's why you should invest in the stock market. It definitely helps you with your long-term gain in whatever your goals, your particular goals are. I'm going to close out with this great quote from Warren Buffett. If you don't find a way to make money while you sleep, you'll work until you die. And although that may not be a good prospect, it shows the reality of what we're faced with in the future. Pensions are all struggling to come forward. That's the state pensions in particular. Therefore, making early financial decisions and helping yourself become financially free mean you're making your own choices and not rely on other people. So start taking action. Enjoy the rest of the course. I hope this video has been good for you. If you've enjoyed the content, please give us a thumbs up and don't forget to subscribe. Remember the notification bell and you'll be alerted when I release the next video. Until next time, take care.